Welcome everyone to today's webinar. Thanks for joining us. I'd also like to extend a welcome to our Mortgage Choice Amplify and our Connective Elevate partners. For those who don't know me, my name is Tony MacRae. I'm the Chief Commercial Officer for Bluestone. We're excited to be hosting today's webinar alongside Tim Lawless from CoreLogic. Tim and I will talk through the current housing market, the trends that we're seeing and how to navigate through that. I'm sure you're all looking forward to hearing Tim's view. Just logistically, before we jump into it, if you do have a question, please type them in the Q&A section in Zoom, and we'll answer those throughout the session. Also letting you know that there will be one CPD point for attending today's session, which you'll receive after the webinar. And we are recording the webinar and we'll share that along with the slides out to all the attendees in the next day or so. Now, I always say this, but it is true. Tim needs no introduction, but let me just give you a quick background. So Tim's widely regarded as one of Australia's leading property market analysts and commentators by business and the media. He brings more than 20 years experience to the role, providing deep insights and analysis on national housing trends. Tim's expertise across property markets has positioned him as one of the country's most experienced and popular property market analysts and commentators. And unlike a similar debate that's just wrapped up over the other side of the world, I can guarantee you this one will be credible. No need to fact check. There will be no speaking over each other, and we'll commit to finishing on time. Tim, welcome. It's always a great honour to do the webinar with you. Thought I'd just throw out there a bit of a broad net question to start with, the size of the market and how you're seeing that shifting across various states and markets at the moment.
G'day, Tony. It's always a pleasure to be here, mate. And yeah, absolutely. The market is clearly still quite buoyant, at least at a macro level. But we're clearly seeing a lot more diversity coming into the trends, both in terms of value growth, which we haven't seen diversity of this level since 2006, the height of the mining boom, which was the last time we saw a range of performances like what we're seeing at the moment. But of course, we're also seeing some loss of momentum. So it might help if I just share a couple of slides along the way. And I think just to give everybody a heads up on the cadence for Tony and I, we'll have a chat and I'll bring up a few graphs just to reiterate some of the points. So maybe a good place to start is just looking at the overall value of housing at the moment. It's about $11 trillion now. So we've seen the value of real estate has increased over the past 12 months by about 8%. Clearly, that's also our value estimate here is influenced by a level of new construction activity. But of course, as we'll talk about a bit later on, that's not adding as much as normal to the overall value estimate across the market. But just to highlight that, loss of momentum I mentioned at the beginning, at least at a macro level, you can kind of see that on this first graph here, a national graph looking at the month-to-month change in values. Yeah, we're seeing housing values on a national index rising at about 0.5% month on month. The same time last year, it was more than double that rate of growth. We're seeing values rising about 1.3%. Nationally, some markets like Sydney were rising a lot faster than that. And that's where we've generally seen the biggest slowdown in the market and also this emerging level of extreme diversity. So you can kind of see that diversity when you look at the rolling quarterly change across the capital cities. You've got the mid-sized capitals pretty much shooting the lights out, especially Perth. No real evidence of Perth slowing down just yet, or Adelaide. But it does look like these markets are no longer accelerating into this growth trend. They've probably found a peak rate of growth, but no real visible sign of slowing down just yet. Maybe a little bit early sign in Perth. You can see that rolling quarterly growth trend has just eased off a little bit. Brisbane, on the other hand, does look to be slowing down. But each of those three mid-sized capital city markets, Adelaide, Brisbane, Perth, still very much running their own race. And then at the other end of the spectrum, you've got four of the capitals. are now moving through a downturn. In fact, Melbourne's been tracking lower in value over the past 6 months consistently. The last 12 months, values are down about 1% in Melbourne. Sydney's losing a lot of pace. The growth rate there has come down quite substantially. You can see it was actually leading the upswing through early 2023. Now it's sort of a little bit less than middle of the pack. And I think that will probably be a factor going forward, where we'll see further growth leaving the Sydney market amid just a pickup in listing numbers, affordability constraints obviously becoming a little bit more challenging as well. And you can see that diversity has happened over a long time as well, Tony. It's not just the last 3 months or last 12 months. Throughout this whole pandemic cycle, you can see that those mid-sized capitals have built up a substantial margin of growth between the other capitals, particularly Melbourne again, which this weakness we're seeing at the moment isn't really a new phenomenon. It's something that's been apparent throughout the last 4.5 years, partly driven by a lot of disruption economically through the pandemic, but also just simply pretty deeply negative rate of interstate migration. Up until recently, it looks to be leveling out. A lot more dwelling supply coming into Melbourne over the past 15 years, a lot more taxes related to property would be a disincentive to capital flows, less investment, are all legitimate explanations and a combination of those things to explain why the Melbourne market's been relatively weak. And you can see geographically as well, like Melbourne, the downturn really started in the high-end markets, the more affluent markets, your inner east, your Bayside, the northeast, getting down to the Mornington Peninsula. You can see that really clearly on this map that looks at the growth trend over the past 12 months. A lot of the regional markets around Victoria have been extremely weak as well. Ballarat's down 15% from its peak back in early 22. Geelong's still falling in value. But look at the last 3 months in Melbourne. You can see that downturn has really become much more broad-based, to the extent that about 90% of Melbourne suburbs fell in value over the past 3 months. Whereas the growth trend in Sydney is a little bit different. You can see there's still some growth around the outer west on the annual numbers. That sort of latte line, as people call it, that dissects draw a diagonal line across Sydney there. You can see the growth has still been relatively strong across that outer southwest. But the last 3 months, again, you can see that starting to lose a little bit of momentum. More reds coming onto the map as Sydney starts to move into a flattening out or even a downturn. This seems to be quite confined to that sort of 10 to 15K ring at the moment. But I think if Melbourne's a good sign or a good sort of trend to go by, we probably will see some weakness spreading into the sort of the more mortgage belts of Sydney as well.
So, Tim, that's Sydney and Melbourne, and we've got a couple of other states that are continuing to have real strength. Do you see any concerns with any of those?
Well, yeah, I'll be the first to say that the rate of growth we're seeing in a market like Perth isn't sustainable. We're seeing values there rising at about 2% month on month. In dollar terms, that means values are rising about $15,000 to $16,000 a month. Sure, moving from a low base, and there's a lot of catch up at play across the Perth market. We're still seeing listing numbers really low, very strong rates of interstate migration. So the fundamentals are there, which are driving property prices higher. In terms of affordability, Perth's still kind of middle of the pack. Yields are higher than most other capital cities. So I'm not really seeing too many alarm bells going off for Perth. Adelaide's a different kettle of fish, though. Adelaide simply doesn't see the same underlying fundamentals as strong as what Perth are, anywhere near it. In fact, Adelaide's become extremely unaffordable when you adjust for local incomes. Second most unaffordable after Sydney. It's got a negative rate of interstate migration now. I think the one thing that's really holding up Adelaide prices is simply there's hardly any stock available for sale. Construction activity is still very weak as well. So it's that undersupply that I think is the key factor really supporting the South Australian market. But it definitely isn't showing the same, I guess, demographic or economic strength that what we're seeing in, say, WA or Southeast Queensland.
It's probably a good segue to have a look at what affordability is doing across the various markets and how that's paralleling to borrowing capacity.
Yeah, I mean, it's fair to say affordability is becoming more and more challenging. Like, I mentioned housing values nationally are up about 8% over the past 12 months. Guaranteed, we haven't seen household incomes rise anywhere near that, or for that matter, through the pandemic to date, nationally, home values are up sort of 35%. Incomes, especially inflation-adjusted incomes, haven't risen that much. So we have seen an erosion of affordability constraints. You can see it when you start to look at the affordability measures, when you adjust for local incomes as well. Not all of these measures are at record highs. This data's to March, we'll have our June data out later this month. It probably will see a further worsening in affordability across most markets. But if I could just drill into, say, the percentage of household income required to pay a new mortgage, which is the graph on the top right, like some areas are seeing gross income required to service a mortgage on a medium price dwelling getting up around 50% plus. What that really means is, obviously Bluestone probably wouldn't lend to somebody on that sort of margin. They simply wouldn't be able to service their loan, right? What it really means is that if you're on the median income as a household, you probably can't afford to buy the medium price dwelling anymore in a lot of markets. One of the interesting things we're seeing though is Melbourne being a market that's becoming more affordable. This is probably the silver lining behind this weakness in the Melbourne market. It's the one major capital city where affordability is improving, where gross rental yields are actually rising. So there's probably a bit of a silver lining there. But I think the flow-on effect of just worsening affordability and less borrowing capacity, you can start to be reflected in some of the metrics we're looking at. For example, most markets are now seeing the unit sector outperforming detached houses for value growth. So this is kind of unique. It's pretty rare to see a growth cycle that's characterized by stronger unit sector growth, but I think this is a clear example of where demand is being deflected towards lower price points. It's probably also influenced by higher levels of investment activity. First home buyers are also proportionally above average as well, and they're probably more attracted to the lower price points of the unit sector. And we can also see this trend, this attractiveness of the unit sector when you look at the differential between unit prices and house prices over time. I mean, we've seen a massive growth rate in house values through the pandemic to date, up about 41%. Unit values have seen less than half that rate of growth, and most capital cities have seen a real blowout in the differential between house and unit costs. So I think they're becoming much more attractive. And the other, I think, thing going on behind the scenes here is that unit supply, newly built supply, has been stagnant for 5 years now, or more than 5 years. We went through a significant boom in unit construction between 2010 and 2017, and that really slowed down after that. And of course, with construction costs as high as what they are and margin pressures quite stiff, it's likely that the unit sector will remain undersupplied for some time. The other kind of, demonstration of this deflection of demand towards the lower price points, you can see it in our stratified hedonic series, which just looks at the upper quartile versus the lower quartile of the market. And it's really clear across every capital city, this lower quartile and middle of the market is outperforming the upper quartile, which generally led the upswing, but it's now leading the market into a flattening out or a downturn. As you can see on this set of graphs, this is apparent in every capital city, to a lesser extent in Sydney, which is interesting given Sydney's the most unaffordable market. Sure, we've seen a slowdown in the upper end, but you can see that middle of the market and the lower quartile are performing on par with each other. Most other cities aren't showing that trend. And I can only suggest this might be a sign of the intergenerational wealth transfer that's at play across Sydney, where maybe those with equity in their home or you have a benefactor helping you into the marketplace, they might be helping out with things like deposits or guarantees or even buying a home for some of the younger folk who are finding it quite hard to get into the marketplace.
Just a question from the audience, just in regard to the unit performance. Is what's happening with the costs of strata, and is that creeping up as well, and impacting there?
Yeah, good point. Holding costs have definitely increased, both from, clearly interest rates are a part of that, but also things like land taxes, especially in Victoria, of course, have really crept up. Strata fees and insurance fees have also increased as well. So I think it's fair to say for landlords, even though they have seen generally a pretty decent rise in rental income, typically holding costs, when you combine all those different things around higher interest rate payments, higher levies for body corporate, higher insurances, more taxes being paid as well, higher maintenance costs amid the increase in construction costs and labour supply. I don't think landlords are really rubbing their hands together. They've on our numbers, they've seen a much larger rise in holding costs than what rental income has gone up. So I think for a lot of landlords, they are feeling the pain and hopefully weathering the storm. But I think there's plenty of examples in Victoria in particular where investors have had to offload their property because the holding costs have become too substantial.
With the trends you were showing in a couple of the slides there, and are we seeing demand moving away from the centres of the capitals, and more of that urban spread going on?
Well, yeah, absolutely. There's definitely I suppose, a motivation to look for the more affordable dwellings, which tend to be located further afield. Interestingly enough, though, you look at the markets that are moving through a downturn now, and I'll use Melbourne as the best example. As I showed on those maps, the downturn really started in the more higher end markets, which is quite normal for a down phase and also an upswing that generally tends to be led by the upper quartile. But that growth or that slowdown, decline trend is now spreading well and truly to the mortgage belts. But the more important thing, or equally as important, is in the mortgage belt, that's also where we're starting to see listing numbers accumulate. So in Melbourne, classic example will be going out to sort of outer Melton, Werribee, Melton, Bacchus Marsh, those sort of markets. Listing numbers in some of those areas are more than double the 5-year average now. We're not seeing the same sort of accumulation of listing numbers in the more prestige markets. I think a big reason for that would simply be in some of those mortgage belts, you'll find that household balance sheets are going to be more thinly spread, or thinly stretched, much more sensitive to high cost of living and high cost of debt. Whereas in a lot of the more affluent markets, they can probably just sit on their hands, weather the storm. If they're moving through a period where their home value is going backwards, they'll probably just choose not to sell. And that's where stock levels still seem to be quite tight. Whereas the mortgage belts, we've definitely started to see listing numbers accruing. Good news for buyers because there's more choice, but it probably does start to demonstrate there might be some more signs of motivated selling in some of those more mortgage-driven markets.
I might just throw another question from the audience while we're on this Melbourne topic. It says that it's been stated in recent times that Melbourne is expected to surpass Sydney as the most populated city in the country by 2030. Is that still expected? And if so, does that suggest that the Melbourne property market may be undervalued at present, given the likely future demand this growth will generate?
Yeah, good question. A little bit hard for me to comment on where the population might be in, say, 30 years from now. I'd have to refresh myself on the forecasts, but absolutely. Sydney and Melbourne have been pretty much neck and neck on population growth, and we have seen Melbourne outpacing Sydney in population growth with net overseas migration as well. There's a few different measures of what constitutes Melbourne and Sydney on a significant urban area geography. Melbourne's already bigger than Sydney, interestingly enough, but on a greater capital city statistical area, these are formal geographic definitions, Sydney's still quite a bit larger than Melbourne. But that aside, to sort of answer the question outside of responding to whether it'll be bigger than Sydney or not, absolutely, I think Melbourne is building up a competitive advantage to Sydney. I mean, we haven't seen a price differential between these two large markets this wide since around the early 2000s. So Sydney's going up in value, Melbourne's going down in value. A few of the smaller and mid-sized capitals have seen the median dwelling value get higher than Melbourne's, which is unique for somewhere like Adelaide to be more expensive than Melbourne. I mean, part of that's compositional, but still, it's quite an inflection in the market. So I think the fact that we're seeing Melbourne housing values becoming more affordable, that yields are rising, does start to highlight this market's becoming better value. I'm not going to say undervalued. Maybe that's something that it will be shortly. But compared to, say, the competitors, being Sydney or Southeast Queensland, Melbourne's looking much better to me for a medium to long-term view. I don't think the Melbourne market's going to turn around and become positive anytime soon. There's just too much listings in the market at the moment. But maybe when interest rates come down, we will start to see Melbourne showing a positive inflection. And I think absolutely for the medium to long-term investors or people looking to pick the cycle over a longer period of time, Melbourne's starting to look pretty good to me.
Well, there's a tip. Let's jump on to what's happening in the supply and demand side of things and how that's driving various dynamics at the moment.
Yeah, okay. So, I mean, this has really been the crux of what's been placing upwards pressure on housing prices. At a time when we're in an environment of elevated interest rates, a cost of living crisis, as some describe it as, with inflation being so high, we've got consumer sentiment holding around recessionary levels for the last 2.5 years now. Yet we're still seeing transactional activity that's been a little bit above average, and we're seeing housing values rising. So, I mean, the transaction trend does look to have probably moved through a turning point now. It looks like just on the rolling quarterly number of home sales, the peak in transactional activity was probably around March of this year. And you can see that was holding above average, apart from the seasonal dip through December, January. That's just normal. Through most of 2023, coming into 2024, at least the first quarter, was on an upward trajectory of transactional activity. Quite unique when you consider that, the headwinds the market was facing. But it does look like that transactional number is now coming down. And I think that's probably just a sign of, sentiment remaining so low and affordability pressures starting to shine through, blocking more activity, borrowing capacity remaining quite tight as well. So that'll be one to watch. I think we probably have moved through the peak level of purchasing activity, but this is occurring at a time when home sellers are becoming more active. So on one hand, you've got the demand or demonstrated demand is starting to ease off, but more properties are coming on the marketplace. You can see that in the graph on the left here, which looks at the flow of new listings. So new listings started to pick up a little bit earlier than normal. So typically you would see spring being a more active time for listings coming on the market. And you can see that on the dotted trend line here in the graph on the left, normally you'd start to see listings picking up about now, second week into spring. The pickup in vendor activity started in the first week of August. It was a bit early last year as well, but that was after a long period of vendors being very inactive through the early phase of the rate hiking cycle. So I think this pickup in vendor activity is a sign that the spring and early summer selling season is going to be quite an active one. But on the previous slide, we've seen that we probably won't see a commensurate demand response lifting to meet the flow of new listings coming into the market. And you can see the graph on the right, we're already starting to see a very gradual lift in overall supply levels, overall advertised supply levels. That tells me that demand isn't quite meeting the flow of advertised supply, so absorption isn't quite positive at the moment. But you can see when you look at across the different capital cities, that trend is very different. And this is probably one of the best explanations of why, for example, Melbourne or Hobart are in a downturn. Listing numbers are really elevated in those markets. They're about 30% above average in Melbourne now. They've been holding more than 40% above average in Hobart for a couple of years. And you can see Sydney is now just nudging above the 5-year average as well, which is probably my warning sign that I think Sydney will continue to lose some momentum coming into spring and early summer. With the really strong markets, Brisbane, Adelaide, Perth, particularly Perth, you can see that listing numbers remain really low. Just a little bit of upwards pressure starting to show through on Adelaide and Perth. Brisbane, though, visibly just starting to lift in supply levels, helping to explain that reduction in the quarterly rate of growth across that market as well. So yeah, I think that the listing numbers will be a really important trend to watch over the spring and early summer season. It really does help to explain the capital growth or decline trends.
Another question from one of the attendees. Are you seeing vendors being more willing to meet the market more so than, say, 6 or 12 months ago?
Yeah, absolutely, especially in the markets where listings have become elevated. So I know I'm picking on Melbourne a little bit, but it's just a good example of a large capital city that's moving into a downturn, and it's now seeing elevated stock levels. So we're now seeing on our private treaty metrics, which are median selling time and vendor discounting rates, it's taking about 40 days as a median to sell a home in Melbourne. In markets like Perth, it's taking 10 days. Vendor discounting rates are just starting to pick up in Melbourne. There's always a lag as you see sort of time and market extending, then gradually that'll flow through to larger discounting rates as homes sit on the market for longer and vendors get more willing to be flexible. Again, there's hardly any discounting happening in markets like Perth or Adelaide. Auction clearance rates, which are a really good timely measure of the fit between buyer and seller expectations in markets like Melbourne and Sydney, which are very auction-centric markets, we're definitely seeing clearance rates have faded a little. They're holding up pretty well, given the state of the market in Melbourne. They're coming in finalised at around sort of 64, 65%. The decade average in Melbourne's about 65%. So it's just slightly below average. But again, I think as we see stock levels accumulate, you probably will find vendors are adjusting their expectations a little bit lower. That's a gradual phenomenon. What real estate agents describe as, educating the vendor or coaching the vendor about the market conditions. Generally, people selling their home, their expectations are up here. The market might be down here a little bit. So that's a gradual phenomenon to come through. But yeah, I think given the fact that clearance rates in Melbourne are holding around average levels, that probably does suggest that vendors are motivated to actually meet the marketplace. I think if they weren't, we'd be seeing a clearance rate that's quite a bit lower than what it is at the moment.
Excellent. I know here at Bluestone, we're seeing a nice pickup in investment or lending to investors, and I will throw in a little plug. We do have a campaign on at the moment that waives that investment loading on all investment loans. So take advantage of that for any of your investing customers. But Tim, are you seeing same sort of thing across the market with investors picking up?
Yeah, absolutely. Again, diversity would be the underlying theme here. But markets like WA, for example, have seen more than 100% increase in the value of investment lending over the past 12 months. It's been extraordinary. Broadly, I mean, on the national numbers, again, I'll share my screen here for the national numbers. You can see investors are about 38% of mortgage demand now. That's quite elevated. Nowhere near the sort of levels we're seeing when the first round of macro-prudential policies rolled through back in December 2014. Back then, investors were sort of more like 45% of mortgage demand. But, we're heading that direction. And investment credit growth has been quite strong as well. We've been seeing investment credit growth tracking at about 35% per annum at the moment, way above what owner-occupier credit growth is, which is about 21%. So I think it's fair to say investors are fairly motivated to be active in the marketplace at the moment. Probably, maybe this is a little bit of a warning sign as well, because when you look at the spread between investor mortgage rates and gross rental yields, which you can see that in the graph on the left, mortgage rates, at least on the RBA series, about 7.5% for investors. That does sound a little bit high to me. No doubt there's much better rates available for investors. But anyway, looking at these two data sets, a 3.7% gross rental yield, that's probably going to be under a little bit of downwards pressure because we're seeing a bit of easing coming out of rental markets now. Of course, hopefully interest rates aren't going upwards anymore. They will come down eventually. But the spread between the two hasn't been this wide since sort of 2006 to 2008 period when investors were quite active back then. But it just demonstrates that investors don't really care too much about opportunities for cash flow, with yield being so low relative to mortgage rates. What they're really focusing on is opportunities for capital gain. And I think it's one of the reasons why we've seen a lot of investment activity coming into markets like WA, Queensland, South Australia, where value growth has been so much stronger. I mean, just going back to the previous slide here, despite yields being as low as what they are in New South Wales, typical gross rental yield in Sydney's sort of low threes, you've got the largest proportion of investment activity happening in that market. It's not far off long run averages. So for whatever reason, New South Wales always seen a larger proportion of investment. But it's in a market where yields are extraordinarily low. And you'd have to think there might be a little bit of a risk profile emerging with investment activity quite elevated at a time when finding a positive cash flow property is kind of like a needle in the haystack, unless you have a large deposit, of course.
And so what's all of that doing to the overall rental market, Tim?
Well, yeah, interestingly enough, I mean, you'd have to argue that a lift in investment activity is a good thing for rental markets. Even though most investors invest in established housing stock rather than new stock, arguably more investment means more rental supply coming through, unless they're buying off other investors. So you can start to see, or maybe alongside more investment activity, but also a slowdown in net overseas migration and rental affordability pressures. It's pretty clear rental growth has moved through a peak. I think we've now moved beyond the boom in rental conditions. So if you look at the rolling annual change in rents, again, pretty macro graph here, you can see it really clearly. Annual change in rents is easing, particularly in the unit market, where a year ago we were seeing unit rents rising about 15% per annum. That's more than halved, down to a little bit less than 7%. House rental growth not easing quite as visibly, but also didn't have quite as much upswing in rents over the past 18 months or so. But interestingly enough, that slowdown in unit rental growth coincides perfectly with the peak in net overseas migration, which was the first quarter of last year. So I think there's a pretty logical argument that as net overseas migration slows down, there will be less upwards pressure on rents due to easing demand side pressures. I mean, you can see that in the cities that attract the most net overseas migration, Melbourne, Sydney, Brisbane, it's clearly the unit sector where rental growth has eased off the most substantially, more than halving on the annual numbers. But even on the quarterly or the monthly numbers, our national rental index was absolutely flat in July and August. That's the first time we've seen no change in month-on-month rents, or only 2 months, since the very beginning of the pandemic back in the early 2020s. So I think there's a pretty clear sign that rental growth is easing off now, partly due to higher investment, but I think the main reasons would be because we're seeing less net overseas migration flowing through. Remember, net overseas migration flows directly and immediately into rental demand. Nearly 90% of overseas migrants are here on temporary visas, mostly students. And then the third reason will simply be affordability pressures. Remember the earlier affordability graphs I showed that nationally rental households were comprising, rental households were spending about 33% of their income on paying rent. Pretty rare for it to get that high, and I don't think it'll really get any higher, which means that rental households need to restructure. And we can see that in the average household size starting to rise as group households reform and multi-generational households become more common as well.
I've had a couple of questions specifically on the Gold Coast come through. So might get you just a comment where you see the Gold Coast going in the next 12 months. Particularly the unit market, and particularly in light of quite considerable growth that they've seen over the last 4 years or so.
Yeah, it's an interesting market. It's still a very strong market as well. The Gold Coast is one of the best performing regional markets around the country. Regional is a bit of a loose term. I know it's it's roughly broadly part of Southeast Queensland, very commutable to Brisbane. It's got its own economy and so forth. So I think that helps to explain why the Gold Coast has been quite a strong market. It's the recipient of significant rates of interstate migration and internal migration. Sure, through the pandemic, that market absolutely boomed. We've seen values since 2020 have increased by more than 70% across the Gold Coast. The unit sector, and this is really quite interesting, through the pandemic, we saw a real skew towards houses rising in value much more than units. That wasn't the case on the Gold Coast. And we're still seeing the unit sector performing pretty much on par with houses across the Gold Coast, which again, I think probably reflects just the nature of the demographic trends coming into that marketplace. Probably a lot of people downsizing, cashing out of some of the larger markets, or buying for a lifestyle reason on the Gold Coast as well. On a supply basis, the Gold Coast market is still chronically undersupplied. It's succumbing to the same supply side barriers that most markets are around the country. It's just very expensive to deliver medium to high density housing stock after such a surge in construction costs and a real shortage of labour supply. And that's even more pronounced, arguably, in southeast Queensland, where there's a huge amount of big infrastructure projects underway, partly related to the Olympics, but much broader than that. Of course, big infrastructure tends to compete for the same materials, the same labour force as residential construction as well, which is keeping a lid on supply. And for that reason, I think the Gold Coast will continue to be a fairly positive market. Obviously, we don't expect values to keep on rising as quickly as they have over the past few years, but it does look like a market where this ongoing demand-supply imbalance is going to keep some upwards pressure on housing prices.
Thanks for that. I'll just remind participants that if you do have a question, use the Q&A tab on Zoom. And I also remind that we will be sending a copy of the presentation and the webinar out in the next couple of days. Tim, always an interesting one. Governments all around the country have set themselves ambitious new housing goals. I suppose, how are they going against it, and are they realistic?
Yeah, so got some context. Coming out of the National Housing Accord, which was, 18 months or so ago, the government came to the marketplace and said, we're going to build 1 million homes over the next 5 years. And then a few months later, they doubled down and said, it's actually going to be 1.2 million. I mean, 1 million was already a bit of a stretch target. I think everybody acknowledges politely 1.2 million is undoable. It's a great ambitious target. I think admirable. It's good to see the federal government really putting themselves out there to challenge the marketplace to deliver a supply response. But the reality is, this is going to be a really, really big challenge to deliver this much supply. So if you start to look at some of the underlying dynamics here, like the last time we delivered anything close to 1.2 million homes was the 5 years ending December 2019. You can see in the graph on the bottom left here. That was characterized by a significant amount of multi-unit dwelling delivery to the marketplace, a real densification, particularly in Sydney and Melbourne. It was also a time when foreign investment in the Australian economy, particularly the housing market, was much more significant than it is at the moment. And for foreign buyers, there's still a lot of barriers and higher taxes and higher application fees and so forth to contend with. So if history is anything to go by, even during a period of much lower dwelling costs and higher levels of investment, we didn't build 1.2 million homes, let alone 1.2 million well-located homes. And remember, that was also a period that was punctuated by some real construction quality issues as well, in a period of rapid growth and self-certification that didn't really work too well. So to highlight the challenge, we're in a market now where dwelling approvals look like they've bottomed out. I don't think we'll see a further fall in dwelling values, at least in trend terms, but they're way below where they need to be. So to deliver 1.2 million homes, you generally need to see 20,000 approvals a month. So we're already a couple of months into this 5-year target that kicked off on the 1st of July. No real sign of approvals picking up materially, but we don't expect them to either. Maybe the savior here, or at least the kickstart to getting more supply into the marketplace, is the graph you can see on the right, which kind of helps to get through the quagmire of the approvals process, which most people kind of talk about some of the barriers to housing supply. It starts with, town plannings being prohibitive, there are town planning policies being prohibitive, red tape, all that sort of stuff. That's much less of a concern now that we have this accrual of stock that's been approved and been commenced, but hasn't been completed. Just to put that into some context, if you look at commencements coming into the marketplace, they're all trending lower. But if you really want to focus on a low-hanging fruit or where we can probably kickstart supply coming into the marketplace much more quickly, it's in the multi-unit sector, where you can see really clearly, like New South Wales, a little bit more than 50,000 apartments are ready to go. They don't need to be approved. They're waiting to be built. Victoria, about 41,000. I mean, everywhere is elevated, either around average or a little bit above, or a little bit below average levels. So I think for a government that seems absolutely, committed to trying hard to get to this 1.2 million target, this is where they're going to be focusing their efforts. And I think what we should expect to see will probably be some levels of stimulus or incentive for developers to get this type of stock into the marketplace. Strategically located multi-unit sector dwellings that can be delivered to the marketplace within a medium time frame. So one of the biggest barriers, of course, is this bulge in construction costs that we've seen. Even though we're not seeing construction costs rising anywhere near as quickly as they used to be, they're still rising. 2.6% growth in construction costs the last 12 months. I mean, that's the lowest in 22 years, but it's not helping margin improvement just yet. So most builders will tell you that they can't deliver multi-unit sector stock to marketplace for a profit margin, which means we're not going to see a supply response until they can demonstrate an ability to deliver stock to the marketplace with a premium that's acceptable to the marketplace. And also when there's some capacity constraints being freed up. The RBA thinks that won't be until sort of late next year that we start to see capacity constraints freeing up enough that we start to see a more material lift in supply levels. But don't get me wrong, Tony, I reckon ultimately there will be a supply response. The pendulum will swing at some stage. Australia does have, I suppose, a nasty habit of undersupply and oversupply evolutions. So in a couple of years' time, I don't think we'll have the same demand side pressures because net overseas migration will have eased off back to more normal levels. But we're probably still going to see, this current focus flow through to a supply response of some magnitude. That maybe is where we start to see some risk of housing markets behaving more negatively. Remember, the one thing really keeping some support upward support on prices has really been an undersupply. And if we start to see that changing over time, then you'd have to think the market will probably move through a period of flat to falling conditions, allowing affordability to catch up and supply levels to do the magic.
If you were to put a estimate on time, that sort of a 2-year horizon that we should be sort of keeping a watch on?
Yeah, 2 years maybe is a bit conservative, especially for the multi-unit sector. So if the RBA is right and we start to see more sort of work being done by the end of next year, I think it's fair to say like a large-scale multi-unit sector project is going to take 18 months to 24 months at least to get into the marketplace. So probably more like 3 years or so before we really start to see a material supply response. The greenfield sector, like detached housing on large-scale subdivisions, is probably a little bit more reactive. It's easier to trickle that stock into the marketplace. It doesn't have the big bang. It doesn't have the same profit margin squeeze that high rise has had. So maybe that's where we'll start to see earlier phase of a supply response. But I think for most large capital cities, at least, there's going to be a lot of focus on densification and delivering more affordable types of housing to the marketplace, particularly in line with strategic locations along transport spines, close to major amenity working centres and so forth.
We've all heard the stories and may have seen local high rise, and apparently they're all sold, but you go by overnight, they look vacant. Are you seeing anything happening in that space?
It's a really hard one to measure, Tony. Like, I mean, if you look at vacancy rates, they're still extraordinarily low. Sure that they have lifted a little bit. Inner city markets are still looking really tight from a vacancy rate perspective to me. So it doesn't really ring true. There have been some studies that look at things like water usage or utilities services connections and whether or not they're being used or not. That's probably the best we can do at the moment. But I think the underlying maybe myth or theme there could be that an element of foreign investment has come into some of the unit sectors and simply that they bank that type of stock. But I think given how tight rental markets are, some states have vacancy taxes as well, even though that's kind of hard to prove up. I think it'd be a much less component or a smaller component of the market than many people would imagine.
I might just grab a couple of questions that have come from our audience. One specifically about the Townsville market, and particularly for investors, and makes the comment that there's a bunch of buyers agents out there that seem to be keen on Townsville at the moment, and as a great market for investors. So I'd be interested in your view on what that market looks like.
Yeah, it's absolutely booming in Townsville at the moment. It's Queensland's strongest performing market. Nationally, it's one of the better performing regional markets, without a doubt. Obviously, it's come off a low base. It's an extremely affordable market. Townsville is one of the most diversified regional economies in Australia. It's got mining, ports, tourism, education, military. It's got the whole gamut of things, but that wasn't enough to protect the Townsville market from a very long-running period of weakness where values were either flat to falling for a long period of time. And I think it's part of the reason why Townsville is quite strong at the moment. As I mentioned, it's very affordable. It's rising from a low base. The economy is pretty strong as well. So jobs growth, unemployment, each of those sort of major industry sectors seems to be going okay as well. And there's a housing shortage. So I think for all those reasons, Townsville is looking very good at the moment. The only note of caution I'd have is, I mean, historically, it's proven up to be a market that can go through a long patch of weakness. And maybe that's just a reflection of its reliance on resources as a large part of the economy. Or even through the stronger phase back in the early to mid 2000s, there was quite a bit of building in that marketplace as well. So supply levels probably overshot where they needed to be. That's surely not the case now. There hasn't been much construction activity across Townsville over the past decade or so. So no doubt that undersupply is probably adding to things. So yeah, long story short, very good market at the moment, strong rental returns, strong capital gains. I'm just not too sure about what the volatility might look like over the medium to long term.
Thank you for that. I'll ask one other just specific about the Darwin market, and if you see any developments happening on that front.
Not really. I mean, Darwin's been flat to falling for a long period of time. I mean, it did show growth through the pandemic, and there was this real surge in interstate migration through the worst of the pandemic. But at the moment, interstate migration's falling and worsening. There's still a lot of supply in this marketplace, well, particularly the unit sector. Go back to the big infrastructure projects that really drove the big offshore gas projects that really drove the Darwin market sort of through the 2000s and 2010s, early 2010s. I mean, that's what Darwin probably needs is some major infrastructure projects that are going to lift demand for labour force, for interstate migration, and help to get more accommodation to that inner city apartment market. I mean, values in Darwin are still lower than their record highs, which were all the way back in 2014. So on the flip side, more of a silver lining, I suppose, for Darwin, it's a really cheap market. I mean, it's affordable to buy into, by far the highest rental yields. I talked a bit before about finding a positive cash flow property. I think Darwin is probably your best bet. If you're looking for a positive cash flow, you've got a gross rental yield that's sort of a little bit higher than 6%. So that might be appealing as well. And ultimately, you'd have to think with such an affordability advantage, there will be some growth in the Darwin marketplace, but I think it's probably going to be dependent on just a pickup in the local economy, which is, again, probably dependent on some sort of a big infrastructure project coming through the wings.
I will throw one other region in. So regional New South Wales and particularly the Hunter. I know I have friends that have just moved and bought in Orange and appeared to have got an absolute steal for the beautiful property. But what are you seeing there?
Yeah, so regional New South Wales, the best performing markets seem to be the satellite cities, Newcastle and Wollongong, the commutable markets, if you will. I mean, the Blue Mountains has been a relatively weak market, but it absolutely surged through the pandemic, as did Newcastle and Wollongong as well. Getting a little bit further afield, the growth rates don't seem to be anywhere near as strong, although values don't really seem to be going lower anymore either. So getting into markets like, say, Orange or Dubbo, Wagga, Coffs Harbour, each of those markets seems to be pretty flat and still below their record highs, which were sort of back around when interest rates started to rise around the middle of 2022. Another one of the really strong markets in regional New South Wales is the Richmond Tweed. Byron is the poster child of that region. That market did go through a pretty short and sharp downturn, partly driven by some inundation through floods in 2022, but also after the pandemic boom was probably it just saw values overshoot what might be considered fair value. But once again, that market's on the rise, again, still below record highs, but I think, again, it's commutable, pretty decent airport at Coolangatta, Ballina, roughly commutable to Brisbane if you're really committed to do that a couple of days a week. But yeah, definitely, I think the lifestyle markets around the country still have quite a bit of appeal. And I think that's probably just the hangover from the pandemic that we will see this hybrid working arrangements having some permanency, not to the same extent as what there were with people working from home through the height of the pandemic, but it does seem to be, 2 to 3 days in the office, 2 to 3 days working from home does seem to be much more of a normal thing now.
I might just shift gears just slightly. Interested in how the commercial property trends have gone, particularly compared to the resi stuff that you've just shown us.
Yeah, it's definitely not my forte, Tony. I'm very much a residential focused analyst, but so just to qualify my response, it might not be as informed as what it is for the residential market. So, I mean, non-residential, you've got a whole range of different asset classes. So industrial is very strong, warehousing is very strong. Office markets are very diverse. Like if you look at office markets, CBD, prime and A grade style of office space is still quite strong. We're seeing pretty decent cap rates. Rents have come down, sure, and cap rates have come down a little bit. Where the weakness really seems to be is in sort of your lower grade style of office precincts or office markets, your suburban fringe office markets as well. There's a real flight to quality, it seems. So if you can, move your tenancy to a premium or an A grade and pay kind of the same as what you might have been in a B or a C or a D grade building, then clearly you're going to take advantage of that. So maybe you need a little bit less floor space because not as many people are coming into the office. So yeah, a whole range of things. There's a really good article in the Fin Review on this today, just talking about the flight to quality and some of the pain that say a lower grade office space might be going through. Retail seems to be under a little bit of a renaissance now as well after quite a period of weakness. But again, I think that's going to be quite patchy, and probably the longevity really depends on how retail precincts perform over the coming years. We've seen a real blow to consumption with high cost of living pressures. I think when interest rates start to come down, that might start to revitalize some of the retail and consumption spend. But at the moment, I think retail seems to be okay, but probably quite patchy.
Now, I can't do one of these without asking you views on interest rates and what the next move will be and when potential a downward move, but probably more important, what you see happening to the property market when rates do start to ease off.
Well, I think in the absence of a black swan event happening, I think everyone would acknowledge the next move on interest rates is going to be down. It's really just what the timing is going to be. If you look at the mainstream economists, you've got forecasts from everything from November. CBA, the one big four that's holding onto the November forecast. Most economists are looking at February as the first rate cut, but some have May. I think NAB is still at May of next year. Some, on the outer fringes of the forecast, are saying early 2026, which seems way out. I certainly wouldn't endorse that. My view, I think probably February is going to be when we start to see rates coming down. But it's fair to say as well, financial markets are generally sort of pricing in late this year to early next year. So that kind of confirms either November or February is potentially the first rate cut. We've seen New Zealand come down. Chances are US will come down at the next reserve meeting. I think it's next week. Canada's come down a couple of times. UK's come down. So yeah, I think Australia is always going to lag those other nations, probably because we have a much more rapid transmission policy for monetary policy into mortgage rates and consumption because most people are on floating rates. But also, we didn't go as hard as most other Western nations in terms of how much the cash rate increased. So, yeah, to the second part of your question, regardless of the timing, clearly lower interest rates are a positive for housing markets. But interest rates aren't the only thing that influences housing trends, obviously. If it was, we'd be seeing prices falling now. There's also things like affordability that are going to remain a headwind in the marketplace. Whether or not we see a regulatory response as interest rates come down, will APRA ease their serviceability buffer back to say 2.5 percentage points? Not too sure about that. And what happens with the whole supply and demand dynamic? Arguably, as interest rates come down, that should be a good thing for housing supply because it means finance costs are coming down and maybe some of the barriers to getting more supply into the marketplace might start to lift a little bit. So I think it's a really complex dynamic here. I definitely don't expect housing markets to go through a material boom when interest rates start to come down, partly because I think the cutting cycle is going to be a very gradual one. It's not going to happen very quickly. And secondly, I kind of have this sneaking suspicion that if housing markets do respond really positively, we start to see a really strong rate of growth. I mean, that potentially could disrupt the inflation trajectory through a renewed wealth effect and a pickup in consumption. If that's the case, we could see some further regulatory response in the form of, say, credit controls, probably focused on something like, heightened levels of investment activity in the market, which are already nearly at 40% of demand. So, yeah, I don't think it's really all that clear cut, but yeah, absolutely. Lower interest rates are positive for the market, but there's a lot of other headwinds, which I think will keep a lid on the pace of capital growth, particularly affordability and supply potentially starting to show some level of response maybe towards the end of next year.
I did say up front that we would commit to finishing up on time, and unfortunately, as always, we've run out of time again, Tim. So thank you for everyone that joined us this afternoon. Hopefully, you found Tim's insights as positive and insightful as I did. Tim, thank you. It's always a pleasure to catch up with you and hear what's going on in the market. Remind everyone that there is one CPD point that you'll receive, and we will get a copy of today's presentation out to you in the next couple of days. Once again, Tim, thank you. Really appreciate your support of Bluestone and of the broader broker community. It's great to catch up.
Always a pleasure, Tony. Thank you.
Bye now.